The Hedgeless Horseman here. It's August the 4th, 2024. First of all, thanks to the sponsors. Uh, Look at the markets. I think, by the way, that the Canadian markets will be closed on Monday. So hopefully we'll see some really good news from some companies on Tuesday. Again, it's really only news that changes the value of companies, despite price going up and down maybe 20% every week, even without news. Last week, metals closed. I mean, gold was up at 2,519 or something. Silver did a bit of a comeback, sold off later on because mostly I think it's just that basically all the markets sold off. As far as I understand, the Japanese stock market had the biggest fall in quite some time, daily fall, and if it opens up as it was indicated, or let's say as bad as it was indicated to open on Monday. I mean, if that happens, it's supposedly one of the worst 2-day corrections since the COVID crash, I think. And Bitcoin has taken quite a beating, under 60,000 again. Was below 58,000 actually. So I mean that's kind of I guess a bit of a liquidity indicator. Because let's face it, I mean, Bitcoin basically trades with tech and what appears to be liquidity basically. So it could get interesting. I mean, I've been seeing a lot of talk about recession and some bad economic numbers in the U.S. and today I saw that Berkshire Hathaway has been selling more stock than it's done in at least a long time. Of course, Berkshire Hathaway is so much larger today, so I don't know if it's measured in percentage of holdings or whatever, but I think it's like they might have sold half of their stake in Apple. I mean, that's a pretty big deal, I was gonna say. Maybe they see something very specific to Apple, or maybe they really think that, hey, these markets are expensive. We have a recession or global recession incoming, for example, and they're simply taking money off the table. I mean, typically Berkshire Hathaway and Warren Buffett are not famous to be market timers or traders or anything like that, but they are I mean, he's the biggest and most famous value investor. So if he sees, hey, there's not too much value, or Apple is not that cheap anymore, and we can't even expect Apple to grow in the way it has grown, for example, for the last decade or so. I mean, then they're seeing, hey, there's not enough value here, so we might as well take some money off the table. So I don't believe it is that much of necessarily market timing in a sense, but maybe that things have finally become so extreme in terms of valuations that and maybe that tech has gone into a bit of a bubble. So they're like, hey, even if we like Apple as a company, maybe we think it's a solid business and will do well. There's other stuff to buy. Let's say. I mean, the coolest thing would obviously be to see Berkshire reinvest that money in real assets. Like they've been buying oil and stuff like that. I mean, who knows? We'll see. But I would at least take it as a sign, especially a sign of maybe some, let's say, dark clouds on the horizon for the economy, especially since Apple is, given the size and all that. I mean, it's kind of tied into the purchasing power of the people. Let's say, I mean, can we afford to buy new iPhones every 2-3 years anymore? Maybe not. Maybe that's what they see, and they see the value of the businesses going down with a stretch valuation. We can only speculate. But yeah, so Copper's taking a bit of a beating as well. And as always, like nobody knows what's going to happen. Absolutely nobody. We've heard people call for crashes for ages and ages, and they never come, even though there's like, a lot of negative headlines out there. And it's just, other side of the coin is, gold. I mean, you've seen a war in Europe. We've seen not hyperinflation, but like very high inflation. We see the debt burdens. We see what was I going to say? A global pandemic, and still, gold is not at 5,000. It's up, but it's not a ridiculous amount. So I mean, it kind of goes to show there's like nobody really can predict anything. And believe me, I see stuff all the time which makes me want to sell or buy something. You read about AI and how much copper that's going to be needed and supply and demand. I mean, the good thing about supply and demand is kind of somewhat baked in, or I should say the supply side is somewhat, fixed, but it's the demand side that can fluctuate wildly. My point is, even though I feel like selling or buying whatever at any given day, given that I see maybe 500 tweets a day, and typically there's a lot of hyperbolic tweets like the economy is gonna crash, or there's one economic news item. It's like, and someone says, a recession is coming very soon and all that. My point is that I don't make any buy or sell decisions based on stuff like that. That's what everyone else is kind of trying to do, because as always, nobody wants to buy something if they think price might go down. And that you can see on Twitter all the time when it comes to junior mining stocks and whatever. It's like, regardless of how cheap they are, there's going to be people that say, oh, I think they're going to get cheaper. Wait until, whatever. Always the excuse, and that's what people fear. People don't fear that they overpaid for something. People don't focus on, hey, what's the value of this? Did I pay less than the value, AK? Did I buy cheap? That is not the main focus of almost anyone. The main focus is always what do I think is gonna go up in the short term, or what do I think is gonna go down in the short term? If it's cheap as hell, doesn't matter. If people think, and that's typically in a bear market, if they think it's gonna go down soon in the short term, they're gonna sell. If they think it's gonna go up in the short term, meaning typically frothy levels of a bull market, for example, or when a leg, there's been a good up leg, let's say, then they think it's going to go higher, then they want to buy. You see that all the time. You can check yourself, basically. As soon as you see some headline or metals spike down or something, what makes you want to sell isn't the fact that, again, that the case was completely changed. It's just a one-day move or one news item. But it's the idea that's like, you get scared that someone is going to sell it even lower tomorrow. That's really why people do sell low. You don't see a lot of people hating this sector because it's expensive and they can't find buys. They hate this sector right now because they haven't made money in it for a long time, and they think it's gonna, they don't trust it ever going up really until it actually goes up. That's the problem. But for a value investor, news items where the metals are, trading at a given day, or where you think they're gonna trade the next day or week, that's not really something you can build a case with, and that's not really something that should influence your buy and sell decisions, in my opinion. So I've been thinking about some stuff. I watch some videos. I always try to get better. Always try to make my investing strategy more rational in this high risk, high reward sector, or which is typically a high risk, high reward. And I've been saying for some times, like, especially now with gold going up and juniors not really reacting yet again, that beta, proven success, margin of safety, is the thing that's going up the most in risk reward. And it's quite simple, really. Because, okay, might not be totally up to date, but it's like average cost per ounce of gold found, Pacific Rim versus the world. Until 2018. And of course, this is just an average as always, but you can see it trending. I think there was a conclusion in this video, in this talk, where they say that they expect it might be a bit high now, for example, but it's like still the trend is up. Like here's $7 per ounce, $18 per ounce, $85 per ounce in 2018. So that's basically the opportunity cost to an exploration play. If it on average costs $85 per ounce to find an ounce, I mean that's what you pay again in drilling, labor, keeping the company going, geophysics, whatever. If it costs $85 per ounce to find an ounce, and now, for example, given that juniors are so cheap, even the developers, etc., if you can buy an ounce for $30 in the ground, $40 in the ground, I mean, it's like, why even, in a sense, risk it to try and find ounces? Because it costs maybe twice as much to drill up an ounce as it costs to buy an ounce that's already been drilled up. That is why I've also been saying, like, I need to see a really convincing early stage grassroots exploration play today to put money in there. I mean, the targets need to be really good. The company needs to be really cheap and all that, because we can't ignore the fact that a major discovery can revalue like nothing else, or something cheap that makes a pretty decent discovery. Those are the ones that can revalue the quickest. I'm strictly talking about typical risk reward. It's not been this high in quite some time, because it's also a difference in terms of, like, okay, gold in the ground, is it even worth anything? Yes, I think there's deposits out there that are highly economic at today's prices, and you can still buy the ounces in the ground for maybe $30. But if it costs 85 to drill it up, it's like, why buy something that takes twice the amount of money to drill up something that you can already buy? I mean, it really makes no sense. I mean, an analog would be, someone is selling strawberries, for example, at whatever. I'm just making a number up here. $10 per liter. That would, or $5 per liter is what you can buy. Would you want to pay someone $10 per liter to go if he goes out and find it? Let's say it costs whatever, or it takes whatever 10 hours to, I mean, that's an exaggeration, but 10 hours, you pay them $1 an hour. So it costs you $10 to pay someone to find a liter of strawberries. You get to keep the strawberries, but the cost of getting that liter of strawberries is $10. Whereas you can go to some, a stand or whatever, somebody has already picked strawberries, he's selling them for $5 a liter. Why would I go out and spend money to find strawberries when I can buy found strawberries for half the cost that it actually takes to find new ones? I mean, it goes without saying. So I think this is just one interesting thing I think people should think about this. That's like, depending on how the cycle goes and all of that. I mean, when proven success gets sold off really hard, and it costs more to actually explore or drill up the same amount of ounces, I mean, you're not only are you not taking any discovery risk, because there's 100% chance they have drilled what they have, because it's already happened. So you're buying proven ounces in the ground. You're not paying someone and hoping to find ounces. So I mean, it's obviously hard to know everything that goes into this. Meaning, it's like some companies might, they're, let's say, very successful, very predictable ore body. They might be able to drill up ounces for $15 an ounce. So it's a case by case basis still. That's why it pays to be a stock picker. That's why I'm always a stock picker, because every case is unique. And it's like some ore bodies where it's like you have to drill a shit ton of meters. It's like Osisco Mining, for example, which I've been looking at recently. They drilled 2 million meters to prove up 7.4 million ounces of gold. That's a shit ton of drilling, obviously. That's I mean, I don't know how much that costs, but like assuming it's like a few $100 million at least. That's the stuff you would really want to buy when it's cheap, sunk cost. A very capital intensive system, for example, where it took a lot of money to drill up X amount of ounces, and if you can buy that, I mean, I don't know exactly what the drill cost per ounce is for Windfall, for example, but let's say it's $85. Let's just say it's $85. And a system like that typically costs $85 per ounce to find. Then it makes even less sense if you can buy such deposits at $30, let's say, per ounce. Whereas, let's say you can buy deposits for $30 an ounce, but there are some systems or some ore bodies where you can drill it up for $20 per ounce. In that case, it still makes sense to bet on exploration, in a sense. Obviously, it has to be risk adjusted and all that, but it's like, or maybe the best example could be like Snowline, for example. Huge disseminated body. After like 35 holes, you knew it was 5 to 10 million ounces. Compare that to Nagri Lode Gold system, for example. There's no way you can even say you probably have 100,000 ounces after 35 holes. That's an example of, like, yes, there's differences, but that's also what we as stock pickers, we have to account for all that. But my point still is that, hey, now we can buy a lot of success, proven success, for less than it probably cost them to actually drill it up. Or close to it, let's say. And obviously you don't have to take the risk of not finding the ounces. I mean, if you buy a company, let's say 200 million, they have 10 million in cash and they have 5 million ounces, and it would cost you 200 million. So it's like an NPV of 200 million for 5 million ounces. And you have a company with 200 million of dollars, no ounces. It's like, even if it costs $200 million to find 5 million ounces, you would still need to find 5 million ounces. That's not a guarantee. But if you can buy the 5 million ounces, you're not taking any risk, obviously, that, hey, it was only a 1 million ounce deposit or 2 million ounce deposit. So, I mean, you're not taking any risk, really. So that's why especially, I was going to say, like, as I've been talking about, these hybrid plays, there's like, if you can buy stuff for less than what they've already proven is worth, that meaning is like you're kind of set in a sense that sooner or later you're gonna make money, just waiting for sentiment to return. You don't need to find a single more ounce. It's just a matter of when. Typically, yes, stuff can happen and all of that, and companies typically do burn some money, so there might be dilution. And if they don't add value, it kind of destroys value. Instead, yes, that has to be taken into account. But this reminds me of the saying by Pierre Lassonde. It's like, you give me free optionality and I'll make you a millionaire. His point was, when he did royalty deals or does royalty deals with Franco-Nevada, he suggested the market is very bad at valuing optionality. So let's say a company has a pretty large land package, let's say 4,500 hectares, a project, and there's 3 million ounces there. And that company needs money. Franco-Nevada pays them a somewhat fair price that they're gonna get probably their money back at least, and then some, on the 3 million ounces. But they also get a royalty across the entire project package. That's free optionality. You know you're gonna get probably, I mean, the mine could obviously never go into production or something happens, but it was like, for theoretical purposes, they have made sure that they get their money back. So they're paying fair price for what's there. Everything else is upside. So it's kind of a situation where they can't lose. They can only win, which goes back to this, Sun Tzu line of, put yourself in a position where it's impossible to lose. Then it's hard not to win. So that's something I think we all should think about more. It's like I've been thinking a lot about that lately and watching, a bunch of YouTube videos, because like I always say, I want to get better every year. I expect my portfolio in somewhat to change in terms of how the cases are, etc. Maybe, position size and all that. I started off sometimes betting very large sizes of my portfolio on pre-discovery one target plays. I wouldn't do that today. I have some juniors I'm happy to have some exposure in that only have, one massive target, for example, but I'm not doing what I did back then when I didn't have so much money. It's like, put 30% of my position in it and lose 50% in one news release and lose 15% of my entire portfolio. So no, that's not something I do anymore, or I try to keep myself from doing, because that's like, it's easy to get greedy in those cases, because you you buy in the hopes of like, hey, if they only make this discovery, everything will be forgiven. This position alone is going to claw back all the money you might have lost in a bear market, for example. So it's very easy to fall into that get rich quick thing. But I think one should remember what Pierre Lassonde said, and why it makes a lot of sense. So yeah, and I mean, I just started to do a draft basically, and just thinking about, again, opportunity cost. But I've yeah. So it's like, this is the stuff I love to obsess about. It's like investing theory. What makes most sense? Where's the best risk reward? Where's the best risk adjusted returns right now in this sector, given what the prices are out there in the sector? Yes, potential is very, 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 very highly discounted. And I would argue again that since you can buy stuff that is proven success for less than it's worth, if that company has exploration potential as well, that all comes for free. That's risk-free upside potential. I mean, if you buy something that's probably worth 200 million, let's say 200 million at least, and you buy that for whatever 60 million or something. It's like they have something proven. There's like, whatever, 2 million ounces there. It's like, this is probably a mine, or it's at least gonna go up when the sentiment changes. So it's like, that's the bird in the hand. But if they have a lot of exploration potential as well, it's like, let's say they have 5 targets. They drill them. Yes, you might take some dilution, so I guess that's the downside. But let's say they dilute. They raise 20 million or whatever. Let's say the market cap goes from 60 to 80. They miss on all those targets. You still didn't overpay, but you still were exposed to the upside potential of those 5 targets. Maybe if one of them hit and they made a discovery, that was gonna double the 200 million value to 400 million value. So yes, I guess there is some cost to it, in the sense that if you want to do something, you're gonna be raising money, diluting the bird in the hand. But still, I mean, think of the risk reward in that. That's crazy real. That's why I love this sector right now, for example. I mean, it's like a walk in the park for a value investor, or somebody that, dabbles in, risk reward, or has played poker. It's like, what am I paying? What are the upside scenarios? And compare that to a story that has no real exploration upside, but you still buy it at maybe a third of what it's worth. So you have a bird in the hand that's probably gonna generate 200% return at least one day when the sentiment swings. But you don't have anything maybe that's gonna make that go a lot higher if you have to wait, or if it takes 1, 2, 3 years for it to happen. And they obviously have G&A and whatever. So you're still that's gonna be eroding a bit by every year, before the sector turns. But if you have a case where it's like, hey, you get a lot of semi-free optionality at all times, that's great. I mean, it just means more surprises to the upside, and you don't even take risk on it. I think they're by far the most superior place out there. And then there are, of course, twists to that, and by that I mean the ones that actually have an earning agreement with a major, for example. That's like they're gonna be testing a bunch of targets, but you don't pay anything in terms of dilution. That's really great, because again, if you go back to this slide, if it costs quite a bit, or you can buy success typically cheaper than it costs to prove it up. But if you have someone that's funding that, then you don't really care, because you're not footing the bill. You're not footing the bill anyway. So then you can kind of forego, in a sense, the exploration costs. Then you kind of only can look at what are the odds that are going to make a discovery, what's the price of eventual discovery, because you're not going to be the one diluting it. You're not the one going to get diluted depending on if more drilling is needed, or how deep the drilling, what the drill costs are and all that. So that's another twist. And obviously that's not every company that has a situation like that, but that obviously skews the risk reward, and the idea of value erosion thanks to dilution and time and all that. So then it's like you can kind of almost cross over the actual opportunity cost, in a sense. That's like, well, it doesn't matter if the drill costs are $100 or $50 per ounce, because I'm not the one paying for it. So then you can kind of forego this number here. That's one way to think about it, I think. So it's like, I guess my point, this is why I love investing, I think, because it's a constant puzzle to solve, and the puzzle continuously change, and you can never really you can never reach perfection anyway. First of all, it's too hard to actually estimate true probabilities, so you have to just kind of go for no-brainers, where it's like, I don't know if the chance of success is 2, 3, 4, 5, 6, 7, 8, 9, 10, 15%. But it's like, it's probably, let's say, 5 to 12% chance of success. It's pricing in a 2% chance of success, something along those lines, where it's like, I have a very hard time that I'm overpaying for this high risk, high reward situation, at least. Whereas like if anybody could knew the exact odds, then it was like, yep, I can see here it's a definitely, God said this to me, it's a 12% chance of success. It's selling for only pricing in only a 3% chance of success. Obviously a no-brainer from a risk reward perspective. That we can't do, obviously, but thankfully this sector during bear markets gets so cheap that is pricing in ridiculous, in my opinion, pessimistic odds of success. And there's a bunch of multi-project explorers that I think are based on the sum of its parts, pricing in a ridiculous low chance of success. And then you look at who they're partnered with. It's like, well, this makes no sense really, because these are the biggest companies in the world, and if they think this project has potential, then they think probably it has at least a 5% chance of coming up with something worth a billion or $2 or $3 billion, and it's pricing in a 0.4% chance of that happening, then it's like, well, there might be a 90% chance of failure, for example, or 95% chance of failure, but it's like it's still way underpriced. So it's a no-brainer from that perspective. You just have to diversify away the risk. I mean, if it's a 95% chance of failure, you would need at least 20 such stories with the same position size to diversify away the risk, or expect to get one win out of 20, for example. Anyway, let's dig into some news. Eloro Resources, Cantor Fitzgerald came out with a target price of $5.5. Stock, right? I think it's a bit below $1. Someone has that linked in the CEO channel for Eloro, so you can read that and make up your own mind. Obviously, I mean, I think it's what was I gonna say? I mean, if we fast forward the tape a bit, I mean, put out a PA larger, higher grade or high grade starter pit and all that. I think the economics could look quite favorable. It's like it's a huge project, obviously, so there's a lot of exploration potential, but there's also infill drilling potential, which, I mean, if they do prove up a better high grade starter pit, that's going to help the economics a lot. And obviously now it's kind of somewhat left for dead. I mean, I think the narrative is that this is just a very low grade, very large system, but I think Eloro could surprise on the economics, especially assuming if they get the high grade starter pit to grow. And obviously, I mean, you're probably, almost regardless, you're probably gonna look at a very, very leveraged polymetallic deposit to metals prices. So this is right now, I think, probably one of the most sensitive to beta, meaning sentiment, basically. So if we transport ourselves to the future, let's say 2 years, and there's a roaring bull market in silver and metals overall, and they have a PA out and all of that, which shows the leverage. I don't think that target price sounds crazy at all in that case. I mean, I wouldn't be too surprised if, well, I'm not gonna say actually what I think the NPV could be. I only noticed, like, yeah, this is a huge system. If you look at the copper porphyries out there, for example, most of them have very, pretty low IRR at today's copper prices and all that. So yes, everybody's ecstatic about copper, but if you look at the projects out there, I mean, the economics don't look good. If you look at the gold developers, the gold projects at spot gold price, I mean, they look insanely profitable. And that's obviously why I, at the top from risk reward perspective, I still have the gold juniors. But there's some that's like gonna have huge torque. I mean, I remember how much Bear Creek Mining can move from bottom to top. I mean, it crashes 80-90%, then goes up 500%, then down again, and all of that. And I think this is probably a more robust project than the large silver project that, or it's gonna be at least, than Bear Creek has. But yeah, so it's like expectations. Well, this is very much tied to sentiment. That's what I think. Unless they make, a discovery that, really changes the narrative, or they keep hitting, high grade material closer to the surface, so the market can start to figure out, like, hey, this is probably gonna have very good economics, something like that. But other than that, I think it's tied. This is right now it's very much a beta story, I think. So I think it's very much tied to the sentiment, because it's already huge. I mean, it's going to be hard to double the endowment. Well, yeah, I mean, it's probably, it's going to take money at least. So that's not going to happen anytime soon, I don't think. But at the same time, do you need it? If you have a huge deposit already, might as well, put out a PA, get the starter pit, high grade starter pit going, so people can see, and hey, this is actually a legitimate project, not what everybody else has said that's like this is crap because the global grade is at whatever. Because there's obviously a bunch of very large porphyry projects, for example, that have very low grades and they still make money. I mean, San Cristobal isn't that high grade. That makes money. It makes a lot of money right now. And this is, somewhat on par with those grades. So yeah, I think Eloro is underestimated, but I can understand it now with, I think the market is waiting for expecting a financing and all that, and then it's like, what happens with juniors when the market thinks they might be raising. It's like regardless what the value is or price, there's like seems to be chronic selling pressure. Brixton, I didn't cover this when it came out. Brixton Metals provides initial assays from the 2024 drill program at its Thorn project with 1,467.7 meters of copper, silver, molybdenum with several subintervals. So the largest widths, 960 meters of 0.39 copper equivalent. And then there's, a high grade like 450 at 46, almost 449, 121 at 0.55, 8 meters of 1.21, 150 meters of 0.56, yada, yada, yada. So, I mean, I think we can conclude one thing, as it says here. Significant increases the volume of mineralized porphyry at Camp Creek. That's a huge intercept, obviously. I think that today, in today's environment, we would like to see 0.6, 0.7 for it to be considered like, this is looking like an, tier 1 huge block caving operation. That's what I think. I mean, market didn't react too much, for example. So that's what I kind of hoping to see. That's what I think Brixton is also hoping to see. They want to get into what they believe is like, okay, can we find a higher grade core where you have grades, 0.6 up to maybe 1%. That would be a total game changer. That I think would probably change the story overnight, and that's what they hope to see. In the meantime, obviously, they're showing that, as it says, significantly increases the volume of mineralized porphyry. So, I mean, if we're being very long-term oriented, for example, or maybe there's a new technology that comes along, or whatever. I mean, let's say you prove up, now I'm just, again, speculating here. Let's say you prove up like 2 billion tons of, 2 billion tons of 0.4 or 0.5%. It's like that's typically, I would say, deemed too low for a block cave operation today. But it's like with a lot of, the entire mining sector really, we've seen grades come down since we started mining. I mean, the old timers with gold, I mean, they mined visible gold. They didn't do 2 gram per ton material. They didn't do probably not even 5 gram per ton material. They needed to see bonanza stuff, basically. And obviously no dissemination really. They didn't do disseminated stuff like the Carlin deposits or whatever, where you can't even see the gold. But today that's obviously worth billions of dollars. So one could say that at least this is kind of hiking up that, hey, this is going to be incredibly leveraged to copper. Now nobody knows what copper is going to do over the next 10 years. But let's say there is an actual supply crunch of copper, and it's like even if you take the mines that are higher grade than this, and the amount of time that's going to take to bring them online, and then you figure how much, the fact that the other copper porphyries, I mean, no copper porphyry lasts forever, so you have to replace the ones that have high grades now because they're going to run out. This is what, I mean, Ross Beatty, what he made $1 billion or $2 billion on was buying up uneconomic copper deposit during a bottom in the market And those copper deposits in the future became economic because copper prices went up. And then he sold them for $1 billion, and he bought them for, I don't know, I'm guessing it's like 30 million, something along those lines. They might still be more economic than these, at least these bulk intercepts here, given the depth and all that. But the point stands, is like, what is sub-economic, let's say, today's copper prices in today's environment that could be economic sometime in the future. Of course, we don't really want to need to have a, I'm just going to wait for, 10 years for the copper price to be at $7 or $10 or something. That's maybe asking a bit much. So, but I would still just point that out. I would like to see like 0.6, 0.7, more 0.6, 0.7 stuff. This is almost 0.6 at least. This is 64 meters, but like you would want thicker intercepts than that. But it does significantly increase the volume. So it's like there's a shit ton of metals here at Camp Creek. It's just they have yet to hit the more of the higher grade stuff that you can tie a huge higher grade resource around, which would probably be very competitive in today's copper environment. Yeah, so that's where I would leave that. But again, the drilling continues. They recently JV'd or earned out, I guess one could say, a gold project to Eldorado. So now Brixton has BHP, which have funded them twice in a row for the copper potential in the huge Thorn project. They have Ivanhoe Electric, that's, as far as I understand, still drilling very much at Hog Heaven. And they have Eldorado Gold working their gold property. So obviously, if you have players like this that involved, it's like the largest company in the world, Ivanhoe, and Elephant Hunter, Eldorado. I don't know exact market cap, but like by definition, they're saying there's $1 billion potential. They see $1 billion potential. That's the thing. That's all you need to know. You're not a pumper for saying that. That's common sense. BHP would need something worth, I don't know, 5 billion plus. Ivanhoe, I mean, they're just an explorer. They don't have that kind of a threshold, but they're after stuff that's worth 2 billion plus, probably. So it's like, you obviously don't know better than the best in the business. So if they think there's potential, there is potential. Question is the probability, and that's impossible to say. Even they can say that. But with that said, they obviously see some potential, meaning it's probably not a 1% chance, because in that case they wouldn't give it the time of day, I assume, for example, because there ought to be better projects out there in that case than a 1%. Strategic investors exercise warrants early. Goliath Resources receives proceeds of $1.8 million, and it also says there's still over $9 million of warrants that are in the money with an average strike price of 63. So I mean, this is one thing that I think is holding Goliath back a bit, given us okay, they put out 2 really good news releases in a row. It's like first abundant visible gold in 3 zones, then the first zone came back with assays like 35 grams per ton over 6 meters. Like that's a bonanza intercept, and there's 2 more zones to test just in that hole, and they're drilling 6 holes around that. So it's like, I think we can kind of prepare ourselves that there's going to be some bonanza hits, or at least high grade, pretty good widths, like really good holes coming out of Goliath over the next few months, a few months, because they're going to be drilling more. I think they have 3 drill rigs. But again, I think this is a situation where it's like the market, and obviously anybody who's watching this and don't have a big position, it's like, hey, you probably need to raise money. What do? Well, if you want to get in with bulk, you're not going to buy in the open market. You want to get in as cheap as possible. So you're going to be hoping that the price doesn't go nowhere. So even if you think the news is really good and you want to really get in with bulk, you're not going to bid up the price in the open market. You want it to stay here. So the better the story looks, if you have a lot of money to invest you don't want the price to go up, so you're not going to be out there, but you're going to be more and more obviously enticed to get into a financing. And the same goes maybe for shareholders that already have shares. It's like, okay, I hope they're going to do a financing soon. I don't need to rush into it. I can sell because I think they're going to be needing to raise soon, and also I can sell and keep the price down so I get again a better entry, and maybe hoping you get warrants and all that. And that's even more so the better you think the store is. So that's the funny part. Like when financings are, that's where the big boys play. Obviously, the institutionals, etc. They typically don't go into the open market when they want to get a big position because they're going to drive up the stock price too much. So even in a good store that might, a store that's getting better and people think there's a raise coming, they don't want the price to go up. The better it gets, the more the price should go up, the more they would want it to stay down. And I mean, and you get kind of, so basically what I'm saying is like, the stores that get better and better can get capped in a sense, or it gets hard for them to move up because people actually want to come in bulk at these prices or preferably lower. Whereas you have other stores where it's like the store has not gotten better, but it's like maybe hasn't changed much, like Western Alaska. But that just got killed. You know, low liquidity. Someone can just kill the stock. And it's a good story, so it's like, hey, you should raise money, and they do raise money. But it's like, hey, we made the stock price go down 60%, and now we can get in with a warrant, etc. It's like, okay, they're very happy, an intact story, get in with whatever $1 million, and with a warrant at 52-week lows. They might end up making a kill on that simply because price went down so much. Another one, so Cabral has put out 2 news releases fairly recently. Cabral announces that metallurgical test results from MG gold in oxide material at Cuiú indicate 92 to 93 gold leach recoveries. These are absolute phenomenal leach recoveries. I mean, you look at, I watched a presentation by Quinton recently on, when should you want to have a plant, or when should you just go with pure heap leaching. And he made a few examples, whatever, and he argued as like, the average leach recovery is maybe, I don't know, if I remember correctly, maybe 50 to 70%, and you can see that in a bunch of Nevada operations. They might have around 70% recoveries. 92 to 93 gold leach recoveries seem absolutely phenomenal. You certainly would. I mean, would you want to build a plant if you can get up the recoveries to 95? That sounds like wasted capex in a sense. I mean, depending on if it costs you $1 million, obviously you would. But still, so it's like heap leach is obviously the cheapest form of processing you can do. Because you just stack a bunch of rock and then sprinkle cyanide over it. And this is the oxide material. That's like, I think, free dig, so you don't even have to, really blast it and maybe some, I don't know. But it's like, it's not hard rock. It's not like you have to blast it and then crush it in different to different dimensions. Like you have a whole train of crushers to bring it down to an acceptable size where it can go on the heap leach, for example. So there's a lot of cost with this being free dig. It's at surface, or near surface at least. Loose material, oxide 92 to 90. So this, what I'm saying is, this should be a cash cow. You should not need high grades at all. I'm not a mining engineer, but it's like, given what we know, it's at/near surface. Some is relatively high grade even. It's loose gravels, and you can get 92 to 93 from just leaching, potentially indicated at least. What's the capex of an operation like that? What do you even need to build really? It's like you have to, I was gonna say, move dirt to a heap leach pad, sprinkle cyanide, and you get 92 to 93% of the gold out. I mean, there's no 500 million plant needs to be built. So yeah, I think this is probably something that might not excite retail, for example, but I mean, yeah, and these are indicated, but still. These column leach test results are very encouraging and confirm that the gold in oxide material at the MG gold deposit at QQ is amendable to heap leach processing. The leach recoveries of 92 to 93 are excellent and significantly better than previous test work, which revealed an 82% recovery. And I think that's good. They are also significantly higher than most heap leach gold mines that are currently in operation. These results should allow us to possibly adjust our projected gold recoveries, which form part of the ongoing pre-feasibility. I mean, I can't even guess what a jump from 82 to 92 or 93 could mean on an MPV basis. Could be huge, or significant at least relative to the market cap. These gold recoveries are particularly significant given the recent excellent drill results we are seeing from the Machichi Main and Machichi Northeast targets, which are located only 500 and 650 meters north of the MG gold deposit, and indicate significant potential for additions of gold in oxide material in close proximity to MG. So here's the other. This actually came out before the other one, I think. What was it? 31st and 25th, yeah. Cabral is pleased to announce drill results from 6 additional follow-up RC holes at the Machichi Northeast target QQ Gold District, Brazil, where recent drilling returned 11 meters of 33 grams per ton. I had already forgotten that they got an intercept like that. And this is RC, which by definition means that the hits are going to be quite shallow. Returned 6 meters 13, including 1 meter 77. The hole is a step out hole which probably intersected, step out from the Bonanza. Believed to be extension of the mineralized zone intersected. 50 meters east, the mineralized zone remains open in all directions at the depth. Return 5 meters to 2.2 from 19 meters depth in saprolite, and also 16 meters at 0.3. I think if you have 92% recoveries, you're gonna, I think, make pretty good bank on these intercepts. From surface in overlying soil. Yeah, exactly. From surface as well. I don't know what's going to cost. I mean, yeah, the mining and processing cost could, I'm not going to say nothing, but it's like extremely low. Yeah, I should actually, I want to do a calculation on Cabral's oxide. It would be fun just to give a sense. It's like, what does it cost to move a ton of dirt? I don't know. $1, something like that. I mean, you have a truck, just scoops it up, takes a few ton at one, same time, moves it I was gonna say a few meters, puts it on a leach pad maybe. So yeah, I mean the processing, the mining and processing costs for the saprolite could be absolutely abysmal, especially relatively speaking. Hole 453 returned 30 meters, 0.55 grams per ton from 50 meters in blanket sediments and saprolites, and 18 meters from 51 in saprolite. 450 returned 12 meters from 1 meter depth. Yeah, so it's like this should all be, I think, ore. This should all be free cash flowing ore. The depths, the grades, the indicated leach recoveries. And on that point, and of course, also because this is, I'm pretty sure, is in the hard rock stuff. So it's like this makes it look like, I'm not gonna say it's gonna be a reunion gold type scenario, but if you listen to an interview by is it John Goodman? I think it's John Goodman, the boss of Dundee Corporation. They invested in Reunion Gold based on the thesis that they believe there could be 500,000 ounces of saprolite gold there. So that got them to invest. They believed the price to them was 500,000 ounces in saprolite gold. So, which obviously would be highly significant, otherwise they wouldn't have invested. What later happened was that Reunion found the bedrock source of the gold and proved out, I think it's a 4 million ounce deposit today. I don't actually know what happened to the saprolite. I mean, I guess it got overshadowed, if nothing else. But then you also can understand why maybe G Mining was so quick to jump and buy Reunion Gold, and I think for 900 million. And also, I mean, they're the ones that also are operating the nearby mine, so they appreciate what Cabral is doing. That I'm pretty sure about. And Osisko Gold Royalties are already invested in Cabral, and I mean, if you're a royalty company, all you care about is that can it become a mine or not, and what's it gonna be worth in that case. So they are more than a New York Sprott, let's say. They're more, most of us are speculators. The royalty companies, they actually do due diligence. So like, hey, if this doesn't produce anything, our royalty is worthless. So they need to be sure that this has mining potential. So they're in Cabral. And again, no, it just reminds me a bit about Reunion. It's like, if given the scale here, and here you have historic placer workings, that's all the yellow stuff here. So this is gold that's being mined. So it's obviously comes from somewhere. And they already have, central deposit, that's a hard rock source. I mean, they have around 1 million ounces already in hard rock stuff, and now the main course recently has been the saprolites. But they're also, as they show, are hitting high grade gold, high grade to bonanza grade gold. So again, this kind of sounds like this could be a Reunion Gold situation going on. I'm not going to say it's going to be as big as Reunion Gold, but the fact that it's like they are de-risking the bird in the hand, the margin of safety, the proven success, because they're drilling up more and more of this saprolite oxide gold. They've shown that, hey, if we get 92% recovers, this should be a cash cow, basically. So we shouldn't need too much of this. Again, in the Reunion case, the Dundee guys thought that 500,000 ounces was a company maker, obviously. I don't know where Cabral is up to. I don't know where they're gonna be ending up with in terms of saprolite potential. But it's like, you can kind of have a company maker relative to the current market price on just, I think, the saprolite potential. Again, I haven't done any crude estimates even. I should do that, but we're gonna obviously learn more because we have a PA study coming out. My guess is that PA study might be surprising to people, because if people look at oxide saprolite gold, it's like, you hit some holes like 30 meters of 0.55 or like 80 meters of 0.33. It's like, that doesn't sound too exciting. But you have no idea, or we have no idea, what the margins are on those ounces. Because at the end of the day, that's what, you have some of the most valuable mines. They're not necessarily the largest ones. And you have some that are very valuable, and then they necessarily don't have the highest grades. Because it's margin at the end of the day, and that can come from a lot of places. What does it cost to build it? I mean, a block caving operation might cost you $1-2 billion to build. Here we might have an operation that could start with like 20 million or something, and who knows how much it could throw off. I mean, if they find 300,000 ounces, and it's like, you can mine 30,000 ounces a year, let's say, of saprolite gold, and you have whatever, $1,200 margin. I mean, that's quite substantial. If you get in that case, going back to the optionality thing, there's like all the other saprolite, in that case, becomes free optionality. That is what the PA might show us. There's like, hey, this saprolite, these saprolite deposits might be worth perhaps much more than the market cap of the company is right now, and the threshold for mining should obviously not be high. It's like, oh, you might need to raise 20, 25, 30 million dollars. I'm just guessing here. Compare that to if you have a 500 million capex. It's like, even if it's really cheap, it's like there's no threat of monetization, because if it's a decent mine but it's like 500 million capex, not everybody's going to fork up 500 million capex, and there's no way that a junior can fork it up. So then you're stuck as a pure trading sardine basically, unless you can do something that makes it attractive enough. So I mean, at least you could become a trading sardine and they can go up a lot and all that. But the blue sky here, I think, would be to see that the PA comes out with these new recoveries and all that. It shows that Cabral already has a mine-worthy deposit worth quite a bit more than the current market cap, and we get all the hard rock as free optionality on top, and or more of the all the additional saprolite potential. Because then, of course, the cash flow from the saprolite could fund, if they decide to build it, could fund all the hard rock exploration plus the saprolite potential. So blue sky, I guess, then would be that Cabral becomes a free cash flowing, low capex, high margin producer, not large scale perhaps, but still, and then organically grow. And they have a shit ton of growing to do, because okay, they don't even show the entire project here. But they have an absolute enormous land package, and there's stuff out here that's like, I mean, yeah, where did this gold come from? Where did this gold come from? I mean, they have more targets than they can get to in the next 5 years, basically. So that's a theoretical, or I should say, that's the fire and forget blue sky case. If you own shares today or bought shares today, it's like, yes, I could make a case for it to be like campaign, whatever, 60 million or what the market cap is. I know that's my downside. That could go to zero. Theoretically, anything could go to zero. Obviously, it looks like they have something of value, maybe quite a bit of value. So I would think that actually you're getting a discount to what's already proven. So that's nice. In that case, you're buying it cheap, what's already de-risked. And then anything other than that becomes free optionality. And you come back 5 years later, let's say. Again, I'm assuming here no trading, just to make it as simple as possible, like a hodl case, a fire and forget case. And in 5 years, or 3 to 5 years, like, oh, they have whatever. The saprolite production is up and running. They found 5 to 10 more years worth of saprolite mining. Plus they've shown that, hey, they've followed up on the high grade bonanza stuff discoveries, and oh, they have 2, 3, 4 million ounces of gold or something. I mean, in that case, the market cap is going to be handedly higher than 60 million if they have a multi-million ounce hard rock system with a cash flowing saprolite mine going on. So yeah, that's actually a quite enticing hodl case, I would say. Prismo Metals mobilizes for Palos Verdes drilling. So this is one of the, I think they have actually 3 projects or something. My favorite is the hot breccia, the very high risk, high reward kind of situation. The porphyry target in Arizona. That's what got me interested. But still, they don't show the entire map here, I guess. But the thing is, and I can see the merit of drilling this, even though the project here, as you see, the scale is not huge and all that. But they have, as you can see, 102 grams per ton gold, 3,100 grams per ton silver over 0.5 meters, or 11,520 grams per ton silver equivalent. I mean, that's money in the bank right there, right? So, okay, why are you drilling here? Well, you're surrounded by Vizsla Silver, which I think has the most impressive silver developer story right now in the public market. Correct me if I'm wrong, but I'm pretty sure that's the case. Meaning it's like how big it is, how much land they have. That is like that already looks like a mine. They put out a PA recently, which looks quite favorable. And these guys have these claims smack in the middle of their district scale land package. So obviously, well, I think the Wisla deposit or deposits is going to be a mine one day. And when you start a mine, you obviously have a bunch of sunk costs. So you're going to be wanting to mine, or whoever it is that mines it. You want to have a long mine life. And when you again have spent the sunk cost, that's, you want as much ore as you can, because you already built the mill. That cost you cannot recover, but you can make more money the more ore you can get through it, right? So in that case, it kinda somewhat of a no-brainer, because the threshold for success here should be so low, given that there's already something that's mine-worthy that surrounds this. So in that case, if they show, hey, we have high-grade silver equivalent, we have high-grade veins here, maybe, they can show that you might get a year or two or whatever of production here through your mill down the line. It's like we have in our patch, we might have, and again, this is speculation, this is forward-looking statements. We know there's bonanza grade or above bonanza grade silver stuff here. We know the district is riddled with silver, so you would expect there to be silver here. Okay. So the idea that's like, okay, if we drill a bit here, de-risk it, show that there's more silver to be, there's more silver ore here, more silver mineralization. Obviously, whoever's going to be operating the Wisla mine is going to be wanting to mine this one day in that case. Again, simply because of the sunk costs. So if there was no Wisla silver here and you had a sliver of a land package like this, you could probably not find enough mineralization that you can warrant a standalone operation. So in that case, it would somewhat be money down the drain. But in this particular context, it actually makes sense to prove up this, even if they don't find a large deposit, a standalone deposit, because that's going to be worth something to the ones that will be mining at Wisla. So even if you put in a few holes and show that, hey, there's potential, and this gets bought out one day for 20, 30, 40 million, something like that, I think that's more than the current market cap. So this could be a very much low-hanging fruit. Not a company maker, in my opinion. I mean, the probabilities of that being a company maker is probably quite low. But absolutely low-hanging fruit, because they don't need to prove up much for this to be of not material, but like of real value to Wisla Silver, or the ones that will operate it. So it makes sense, actually. Like, if they give you lemons, make lemonade. So not a company maker, but this could, theoretically, if this gets bought out, let's say they have some success here, they hit that hot breccia and they get to sell this. I mean, that's going to help with on the dilution front, for example, or maybe they hit here at least, and they miss at hot breccia. Well, okay, at least they might have something that kind of underpins the market cap. So I mean, it changes the risk reward, even though it's not a company maker that's hiding here, I think. Well, it would be a company maker if the market cap was $5 million maybe, but yeah, I hope you get my point. Last, I would just say I listened to Doc Jones' interview with Jason. And I mean, basically nothing super new, except there's like, hearing the big thing, just hearing, Jason's vision. I mean, he has probably most of his net worth tied into Magna. He's got, as you know, the old FNX team, a lot of the guys from the old FNX team. This is what they have done. This is what they're probably best in the world at doing. Reviving Sudbury nickel copper PGM rich deposits and actually mining them profitably, as per their, as per FNX Mining's $1 billion merger with Quadra, and then getting acquired by KGHM, I think. But what was really enticing is that, again, I want to know the vision. Since I'm not a short-term trader, I'm not a market timer, all that. I like the cases where it's, again, kind of fire and forget, where it's like, if the case is short-term, you obviously need to be a trader. You need to have somewhat of a good timing. But if the case is that, okay, I'm paying this price today, I think it's worth, let's say, 200% higher already today. So I'm getting that on the cheap. Everything else is free optionality, let's say. And if the company has a credible, large vision over the next X amount of years, means I need even less market timing. I mean, what Jason says, like, they hope to have 3 mines producing in 3 years. I think he said 5 mines in, I think it was 3 years. Well, you can rewatch it. I think it was 3 mines in 3 years, or maybe 3 mines in 3 to 5 years, and then 5 mines in like 10 years, or 5 to 10 years, somewhere along those lines. Anyway, the point is, if they execute on this, like we kind of should expect, or if anybody's going to be able to execute it would be them. Imagine what the value would be in, let's say, 3 to 5 years. Let's say the nickel market had come around. It's maybe even gone on a run again. And you have 3 operating mines in Sudbury, Canada, producing, let's say, pretty good margins because copper, let's say nickel, copper, and PGMs have rebounded. There's obviously a wide range of valuations an operation like that, a 3-mine operation like that, could have. But let's just say that is probably, if they succeed, by definition we know it's going to be higher than the current market cap, or even double this market cap, or even triple this market cap. Again, assuming that is actually, free cash flowing. And then we have degrees of like, hey, if everything goes to shit, we could theoretically lose 100% of the investment. And Jason loses most of his net worth. He's going to obviously do everything he can for that not to happen, and he's going to do everything he can for that not only not to happen, but to actually make as much money as he can as a shareholder. So this is, I don't see, me touching this in the HODL folios, for example. The only bummer right now is that nickel prices are in the dumps, and sentiment with it. Bummer as a holder, obviously, because it's cheap and the sector is fire sale prices. If you have your, you have the position you want, yes, then it's a bummer in the sense that, prices haven't gone up that much, but it's still, outperforming all my other nickel juniors. But yeah, again, these are the cases I think people should really, especially if they want to do the high quality, good return type setup, where it's like you have the day traders and swing traders and all that. They need to be at their computer at all times. They have stop losses and whatever. They can just get screwed with that. Or you have a trade. It's like, oh, I think that the share price is going to go up, but it went down, so you lost 20%, and that's it. That's the trade. Whereas like a long-term value investor, like you're betting on management, for example, it's like, yeah, the stock might go up 50 or up or down 50% in the short to medium term. But if they execute on their plan, you might end up making 500% over 3 to 5 years. And believe me, there's not maybe a fraction of traders that could beat that kind of a return in 3 to 5 years. It's an outrageous return. But the price is that you don't actually do much, and you're going to suck up a lot of at least 30% corrections along the way. That's just how it is. So anyway, thanks for listening, guys. Assume I'm biased. I own shares of all the companies I mentioned, I'm pretty sure. And some, or maybe all, well, not all, but you can see which my sponsors are. So consider me twice biased in that case. But I do encourage, especially to think about this again. It's like the best gift we can give ourselves is to become better investors. Again, think about it, like, okay, what is proven success selling for? Okay, it's selling for whatever. It's like, okay, I have this drill play I really like. I think they could hit a home run, let's say. But at the same time, like, take that, because that's our. If we let our greed take over completely, we would all only be in high risk, the highest risk, high exploration place, like pre-discovery place and all that. But that typically does not translate well into long-term results, unless you're really good or get really good deals and have warrants or whatever. There are exceptions, of course. But it's like, if we take the more pure Lasson route of like, if you give me free optionality, I'll make you a millionaire. It's like, okay, when we have those glasses on, it's like, okay, where do I make sure, especially if I have 20 different positions and I think all of them have margin of safety, I think all of them have banked success that's like 100 to 200% higher than what they're selling for. Then it's just a matter of when, not if, that portfolio is gonna show profitable return. And that's regardless if, yes, some margin of safety you thought was there actually wasn't there. I mean, one could say that Victoria Gold had margin of safety. They had a free cash flowing operation. And they probably had exploration potential. So in that sense, like, okay, maybe I'm paying a fair price or even a bit on the cheap side on the actual mine that's already built and producing. And then I get all exploration potential. But it's like, that doesn't happen too often. I mean, when you're already up and running and it's like, goes from that to bankrupt. So it's like, we have to also factor in that, yes, some of those cases where we think there's margin of safety, but we can't be sure, we might be 90% sure stuff can still happen. But at the same time, we can offset that by getting as much free optionality as we possibly can. I mean, to me, it's like what I like about First Nordic, that I think what Agnico has already drilled up is worth a lot more. Our 45% of the Barsele deposit is worth a lot more than the market cap of First Nordic. That's the margin of safety. That's like, at the end of the day, what's there is worth a lot more than the market cap. So I'm buying something that's already proven on the cheap. Then they have 100 kilometers of strike to explore, and the drilling is cheap in Sweden, and they have 5 multi-kilometer soil anomalies. That's, in my opinion, very good margin of safety, because it's Agnico drilled, Agnico vote of confidence, the best of the best gold, the highest quality gold mine in the world that absolutely knows what a deposit can become a valuable gold mine, let's say. And then you have that amount of free optionality on top. If they make no discoveries in their 100% own ground, they still have 45% of Barsele, which I think is going to be 5 million ounces one day and worth a few billions. So it's like, you'd win if they don't hit any grassroots targets. You just win a lot more if they actually make some discoveries of their own. And this goes from let's say tier 2 project to a tier 1 project. But I hope you get the points. Like, we want to stack as much as we can, as much margin of safety, so we have that free optionality, and then we want as much free optionality as we can find. Because there are obviously cases where it's like, yes, there's free optionality, but they don't have any interesting targets. So it's not a lot of free optionality. It's like, you're probably going to make money on the story, and we're talking about the more low risk stuff now, obviously, because in the drilling, the exploration juniors, there's no such thing. If it's a pure exploration junior, there's no such thing as a margin of safety. The rule is more that they're not going to make a discovery. But I'm talking about the margin of safety, the developers, for example. Then it's like, given what we're at a sentiment low, when we're going to have some returns is more a matter of when, not if. But we also want some ifs on top. preferably. Yeah, you get my point. Not investing advice. Consider me biased. Everything I talk about, I'm biased. Don't invest money you cannot afford to lose. Don't bet everything on one stock. Not two stocks, not three stocks, etc. Assume there's more risk than we think, and diversify accordingly. Not investing advice, not buy and sell recommendation, all that. Thanks for listening. Bye.